$110 billion. That's how much Apple shifted into services revenue over the past 5 years. And one ratio from their latest 10Q filing proves the narrative Wall Street is selling you, that services growth saves the company from hardware decline, is masking a much darker story. If you hold Apple stock, RSU, or options as part of your tech compensation package, this analysis is urgent, not because Apple is collapsing tomorrow, but because the gap between what Apple's earnings reports claim and what the underlying unit economics actually show could cost you real money if you don't understand what's happening. Let's start with the headline number everyone celebrates. Apple Services revenue hit $85.2 billion in fiscal year 2023, up from roughly $46 billion 5 years prior. That's an 85% increase. And yes, services now represents nearly 20% of Apple's total revenue. Wall Street loves this story because services is perceived as higher margin, more recurring, and more stable than hardware sales. Analysts literally use this shift to justify higher valuation multiples. But here's what they're not telling you. This growth tells us almost nothing about Apple's actual business health. In fact, it might be telling us the opposite. Let's break down what's actually happening. First, the hardware cliff is real. Apple's total revenue has grown from $260 billion in fiscal 2018 to approximately $394 billion in fiscal 2023. That's a 51.5% increase over 5 years. But when you isolate hardware revenue, iPhones, iPads, Macs, wearables, the picture gets much darker. Let's use specific data points. iPhone revenue, which represents roughly 50% of Apple's total revenue, hit $206 billion in fiscal 2023. But here's the critical part. iPhone revenue in fiscal 2021 was $192 billion. So in 2 years of supposedly explosive growth, iPhone only grew $86 billion or 4.5%. Compare that to the 85% growth in services during the same period. The iPhone, Apple's crown jewel, is barely growing. Now look at iPad. In fiscal 2018, iPad generated $28 billion in revenue. By fiscal 2023, that number had fallen to $28.3 billion, only a 36% increase over 5 years, which works out to roughly 3% annually. That's not growth. That's treading water while inflation runs at 5% plus. Mac revenue tells an even starker story. In fiscal 2018, Mac generated $25.9 billion. In fiscal 2023, it was $29.4 billion. That's a 13% increase over 5 years or 5% annually. For context, the broader PC market grew faster than Apple's Mac business during the same period, which is extraordinary given Apple's brand strength. So what's really driving that $110 billion services increase? The answer is less about business innovation and more about financial engineering. Second, how services growth is really working. When you buy an iPhone, you're not just buying hardware anymore. You're entering an ecosystem. And Apple has systematically shifted revenue recognition from the one-time hardware sale into recurring services buckets. Consider Apple Music. A customer pays $10.99 monthly. Apple recognizes that as services revenue, but that customer only bought the iPhone because they wanted access to music, photos, iCloud, and the App Store. In 2016, this revenue might have been bundled into the iPhone transaction. In 2024, Apple disaggregates it into services. Same customer relationship, different accounting treatment. Here's a concrete example. Suppose in 2016, an iPhone sold for $700 and the customer used Apple services worth $60 annually. Apple recognized $700 in hardware revenue. Today, Apple might sell an iPhone for $100 inflation plus feature creep, and that customer now subscribes to $150 annually in services. The total customer value increased only 25%. But $150 of it now lives in the services line item instead of the hardware line. This isn't fraud, it's entirely legal accounting. But it's also financial engineering that obscures what's actually happening. Hardware unit growth has stalled, and Apple is exploiting its installed base to extract incremental revenue from existing customers rather than from expanding hardware sales. Third, the installed base trap. Apple's services growth depends entirely on one thing: the size of the installed base of active devices. As of January 2024, Apple reported 2 billion active devices worldwide. This is the bedrock of the services narrative. But here's the uncomfortable question. How many of those 2 billion devices are actually generating meaningful services revenue? Consider the breakdown. iPhones and iPads represent roughly 1.5 billion devices. Macs represent roughly 200 million devices. Wearables, home, and accessories represent the remainder. Not all of these customers subscribe to paid services. iCloud storage alone affects roughly 800 million users, but the vast majority use the free 5 GB tier. Apple Music has roughly 100 million paid subscribers. Apple Care Plus covers perhaps 200-300 million devices. App Store transactions happen frequently, but the average developer commission per transaction is minimal. What this means, Apple's services revenue of $85 billion annually is being extracted from a base of 2 billion devices. That's $42, 50 per active device per year. For context, that's extremely low penetration. If Apple could increase services revenue per device from $42 to just $50, a modest 19% increase, services revenue would jump another $16 billion. But here's the problem, they can't. They've already pushed pricing up aggressively. iCloud storage prices increased in 2023. App Store fees are facing regulatory pressure. Apple Care Plus pricing keeps rising. Apple has extracted most of the low-hanging fruit. Fourth, the margin mirage. Wall Street loves services because it claims 70% gross margins versus 35% for hardware. An analyst might argue, if Apple can shift $10 billion from hardware to services, that's a $5 billion gross profit swing. This sounds compelling until you examine the math more carefully. Services margin calculations are genuinely deceptive. When Apple reports a 70% services gross margin, what's included in that? Server costs for iCloud, yes. Payment processing fees, yes. But what about the cost of developing and maintaining the ecosystem that makes services valuable? What about the engineers, the infrastructure, the content licensing deals that don't show up as direct cost of goods sold but absolutely represent costs? Compare this to Microsoft, which reported 69% gross margin in their productivity and business processes segment, which includes Office 365, OneDrive, and other services, but also allocates significant R&D as a percentage of revenue. Apple's SG&A R&D as a percentage of revenue is roughly 15-17%, spread across both hardware and services. But the marginal cost of delivering services to an existing customer is nearly zero once the ecosystem is built. What matters more? Apple's ability to defend services pricing against competition, and here's where it gets interesting. Apple Music competes directly with Spotify, which operates at roughly 25-30% margins. Why? Because Spotify has no installed base of hardware to depend on. Amazon Prime Video loses money regularly but is tolerated because it drives Prime adoption. Apple Services faces similar pressure. As competitors mature, services margin compression is inevitable. Fifth, what this means for your compensation. If you received Apple RSUs or stock options as part of your tech compensation package, this analysis matters directly to your net worth. Apple currently trades at roughly 30x forward earnings. This valuation is justified primarily by two claims. One, services growth proves Apple's business model is resilient, and two, services margins justify premium valuation multiples. But if services growth is actually a function of financial reclassification rather than new customer acquisition, and if margin expansion has run its course, what happens to that 30x multiple? Consider a scenario. Apple's hardware revenue continues to grow 2-3% annually, in line with mature tech, and services growth moderates from 15% to 8% as the law of large numbers takes effect. Total company revenue growth drops from 10% to 5%. Forward earnings growth expectations compress. Institutional investors rotate out of Apple and into other megacap tech where growth narratives are more defensible. Apple's stock might not crash, but it could easily underperform the broader market for 3-5 years while valuations normalize. For someone with 50% of their tech compensation in Apple RSUs, that's the difference between a comfortable early retirement and having to work an extra 5 years. This isn't speculation. This is what happened to Apple between 2012 and 2016. When the market finally accepted that iPhone growth had plateaued, stock price went flat for 4 years while the S&P 500 delivered 15% annual returns. Conclusion: the real story, Apple services revenue of $85 billion annually, is genuine. The company does have a massive, valuable ecosystem. But the narrative that services growth proves Apple's business is transitioning from hardware to a more resilient software and services company is incomplete. What Apple has actually done is exploit its installed base to extract incremental revenue while hardware unit growth has stalled. That's not a tragedy. It's actually smart capital allocation, but it's also not the growth story Wall Street is selling. For investors and tech workers holding Apple stock, the implications are clear.